hate 401ks. I think 401ks are a fraud perpetrated on the American people. My wife's a lawyer, she has a 401k. The choices, I've looked at them, they're pathetic. They're badly performing mutual funds at best. These are products that somehow pay the 401k administrator extra fees, in my opinion. There's got to be some type of secret arrangement. So instead of being like the Japanese investor over 30 years has lived through up 20, down 12, up 4, down 18, up of choppiness, you go crazy with the stress. Instead of living that way, there are products that allow you to capture the upside every year on equity markets, but have no downside. Well, the first thing is when we talk about life insurance, I don't believe anyone should pay for it. What does that mean? That's a crazy statement, right? Don't pay for it. What I mean by that is just like you go to a bank to finance a piece of real estate, you put down 20%, you buy a home and finance 80%. My belief is you should finance your retirement tax-free plan. You should not pay for it out of your pocket. How do you do that?
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast, and today we have Jason Mandel with us. Jason is an experienced Wall Street executive, a renowned author, and founder and CEO of the Mandel Family Office. Jason has over 30 years of experience helping clients build wealth through tax elimination strategies. In this episode, we talk about the risk associated with real estate investing. What are principal protected assets? Why he thinks the 401k is a fraud. Life insurance as a vehicle for tax saving and investment growth. Insurance versus 401k. What's better for retirement planning? How to finance your tax-free retirement plan. Insurance is a tool to protect assets during events like divorce. What is PPLI and how it can be used to save taxes on all types of assets? How can family offices operate more like banks? And lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help venture capitalists, asset managers, allocators, and family offices in starting their own podcast and building a strong brand. Podcast 10X is designed in a way to work well with the busy schedule of investors, where we handle every aspect of podcast production so you can focus on investing. If you're looking to build a strong investor brand, starting a podcast should be right up your priority list. It's the only form of marketing where you can showcase your strong network, in other words, access to limited partners and founders, and grow that network further. And contrary to what most people hear, it's still very early to start a podcast. There are at least 10x more newsletters and 1000x more blogs than there are podcasts in this world. You can learn more about our podcasting services at podcast10x.com. I'll make sure to add the link in the description below. Enjoy this episode. Hey, Jason, so good to have you on the VC 10X podcast. How are you doing?
I'm great. Thanks so much for inviting me. I appreciate it.
Yeah, it's a pleasure having you on. And I'm very excited to talk about the very interesting topic of, how do we save taxes and how do wealthy families especially, utilize different techniques to save taxes. Looking forward to dive into that. First, let's talk about real estate. And that's a topic where you have some interesting views. What are the risks associated with real estate investing?
Yeah, obviously a very exciting area to have been an investor the past 25 years. There's been some extraordinary performance, both on institutional levels and on personal levels for residential properties. Many people are sitting on 1 or 2x type returns on their original cost of real estate. But of course, there's many different levels of risk when understanding real estate. One is the illiquidity of real estate. This is an asset that's wonderful, but unfortunately, if you needed to get out of it within the day, you obviously could not. It could take several weeks or months to extricate yourself from a real estate investment. People sometimes forget the importance of having liquidity on investments. If someone offered me a 7% rate of return with daily liquidity and a 7.5% rate of return with 5 or 6 month illiquidity, to me, it's no question there's a value for the liquidity. We're high in the cycle. We have to recognize that there's going to be some significant changes here, especially in the U.S. market that I'm more familiar with than other markets. where people are really hindered in selling. They have locked in a mortgage at a low rate. If they were to sell, it's not just a price difference between the two properties. Now it's a cost of maintenance. So when you're looking at that mortgage and that expense of that mortgage, it's significantly higher because the new mortgage rate that they're securing is much, much higher. So there's so many levels of complexity to the real estate market. The one commonality that I would say is whenever you're investing in real estate, especially on your non-personal real estate, but rather your investment portfolio, you really want to take a very serious look at the after-tax reality of that real estate investment. So obviously, we're happy that most real estate new investments include depreciation. So you have a great opportunity to not only get a yield, performance on the investment dollars, and of course it's leverage because most people use bank financing. Commercial wise, a couple of years ago, you were able to get a 25% cash down and finance 75. These days, it's approaching 40% down and 60% finance. So that says something, right? It just says that banks have changed their risk tolerance. Banks acknowledge that the market has risen up so high in real estate. They're concerned that there could be a period of either malaise or potentially contraction on real estate pricing. So in the market, I live in South Florida, and you look at the market, and I actually just purchased a brand new home construction, and there's no weakness in that area. You know, you want a brand new home, you want to live in a community with security, you want to have all the amenities that these communities offer. We're really not going to get any kind of discount anyway. But here in South Florida, due to the terrible tragedy in the Surfside area, there was a building that crashed down, unfortunately collapsed. The government is now taking a look at what is it like to be in this type of climate and for these buildings to now be 30, 40, 50, 60 years old. What effect has this climate had on these buildings? And will they, God forbid, will there be another tragedy? So now the government has taken an active role. And when looking at real estate, they are now taking a look. And when you're looking to buy these buildings, you have an uncertainty, which is quite considerable. And what we're seeing over the past few weeks is a significant, palpable sense of, especially people that are living on a fixed budget, that they're concerned that they could not be able to stay in their homes because of the assessments that the buildings are being given to repair, hopefully repair the damage that's been done. And if they have a $300,000 apartment that they may have bought for $50,000, it's great. But if they get assessed $200,000, that eats up all that theoretical gain over the past 20 years. And more importantly to that than theoretical is they don't not even have cash to pay that assessment. They can't even afford it. They have to move. So what we're seeing now is people that are more astute and waiting before the massive crowds try to exit these particular buildings in South Florida. Some people are starting to post their apartments for sale and they're looking to sell them because they want to lock in those gains and they want to get out before the assessment is finalized. And therefore they believe they'll walk away with a profit. So real estate is complex. What I focus on, because I'm not I'm a generalist. I'm not truly a real estate expert. What I focus on is hiring best of breed managers. So my job is to search the world and find the most talented real estate managers and developers out there, and then allocate money to them through our clients' capital. And when we do that, one of the best ways that we can help our clients is to ensure that they are receiving the returns in the most tax optimized way possible. So in the United States, if someone owns real estate in their own name, obviously we are all individual taxpayers in the States. You would be subject to normal taxes. So for the first few years, hopefully you have depreciation and you're covered, but eventually that depreciation is eliminated and then you're paying full taxes on the rent roll when you invest in your own name. So people got smart and they started to invest inside of an LLC, a corporation. And they said, here in the corporation, it's easier for me to make deductions. It's easier for me to have expenses. I could show less taxable income. And it works very, very well. But again, net of all those expenses, you still have a taxable income because it flows right through to you individually. You're still the net taxpayer. And then people got real smart and they said, well, I know I'm not just a taxpayer every year, but I'm also going to be a second taxpayer when I die. And when I want to leave the money to my heirs, I get taxed again. So they got real smart and they developed all these complex trusts. And that's how a lot of people own real estate, is through a trust. And the benefit is that when they die, there's no tax on the real estate. There's no massive pressure in order to pay that tax. So you could leave that real estate to your heirs without a tax, an estate tax. And that allows the higher likelihood of owning the property for the next generation, because you don't have to try to find liquidity where there may not be any. You don't have to sell half of the apartment building, which you can't do. And therefore, trusts are a very effective way. But trusts still get taxed every year on the rent roll. So don't forget that. It's still a taxable entity. It just doesn't pay estate taxes. So what is very exciting for me about this is the idea that what we've done since 1999, when I formed my multifamily office, we actually focus on structure. We focus on how should a client own that piece of real estate. It shouldn't be in their own name, shouldn't be in an LLC, shouldn't be in a trust. Rather, we should have a trust own an asset which is not a taxable asset. If the legal entity is not subject to taxation, then theoretically it's compliant with taxes, right? You've done everything you've had to do, but if the entity doesn't pay taxes, you don't pay taxes. So the real question, in my view, is someone comfortable thinking outside of the box? Yes, it's nice to say that's my building. I own that building. Or that's my building, that LLC that I'm the managing member of, that I control, and I'm the shareholder. I own that building. Or the trust that I've given to my kids, the beneficiary status, but I control it. And yes, I pay taxes every year, but I control everything. That's a taxpayer. We try to ask people to look outside of the box. We have several strategies that we could talk about, but that's, from here, in answering your question on real estate, real estate is a wonderful asset, but my main comment is, how do we own it? And I'm happy to go through further explanations as to some of the structures that we offer that are tax compliant and tax efficient.
Yeah, that's quite an interesting view on owning real estate and the different structures it is owned today and how it should be owned. Interesting perspective, and something that I learned about from you from another conversation that you had on another podcast was principal protected assets. Because when people are investing into any asset class, there is a risk there and there is some return there, potential return there, right? So what you explained principal protected assets to be is that the principal is going to be protected and then you only have access to the upside there. So tell me more about that.
Sure. Well, most people, when they look at their general investments, these investments that they make, for the most part, are in equities, fixed income, and real estate. Those are your three main asset classes. Some people own commodities, less common, but some people do. And when we look at both, and we talked about real estate, there's a lot of volatility there. We've experienced all this great upside. Now the question is, what happens when people are racing to the doors to leave? What happens with these illiquid assets? So let's talk about what your question was, which is equities and fixed income, and what are these principal protected structures? The structures that I'm referring to are not, the financial advisors in the world are not compensated well by these principal protected products. And that's part of the reason, in my view, a lot of these products are not really well known. They're not really understood. And I think the people, for the most part, that are presenting them are not compelling in any way. So we are in an environment where, when I share basic information about these structures have been around for a very long time. In certain cases, they've been around for 200 years more. People do not believe that they exist because, even though we can prove it all out, because their friend, again, I focus on the word friend, their friend who also happens to be their financial advisor. So you're not normally friends with your doctor, right? You're not normally friends with your gardener, your landscaping company. But for whatever reason, the financial advisor is your friend. He takes you to dinner, he golfs with you, he lets you win, and he's your friend, right? And therefore, when the market gets weak, he's right there to hug you and hold your hand and get drunk with you if that's what you want to do and commiserate and to be your cheerleader. He'll have the pom-poms saying, don't worry, the market's going to bounce back. Just wait it out. It'll come back next week, next month, next year. And in the case of Japan, past 30 years, think about those financial advisors. Oh, it'll come back. It'll come back. It's been flat for 30 years. So those advisors advising their clients, keep it in, participate in the up and the down, because overall you'll do fine, has been the wrong advice, at least in Japan for 30 years. So let's talk about what we have here. And I think many listeners here may not know. On the fixed income side, there are products, contracts with financial institutions, which will give multiple benefits. One benefit is it will give you a fixed rate of return every year. Let's call it 5%. Now that 5% is not that compelling, but it happens to be 5% tax free. So if you live in New York City or Los Angeles, you're being taxed heavily. Over 50% of your gains could be taxed. Depends on how you structure it. Well, making 10% is the same as making 5% net. So these products have a name that all of us are familiar with, yet most of us immediately dismiss, but they do provide this service, which is to give you, instead of your bank CD, giving you a 4% rate of return, taxable, these products can give you a 5% or more rate of return, no taxes. Plus, they will give a benefit to your family in the event you ever pass away. And of course, we all know we all die. These products are life insurance. People, when they hear that, they run away. I don't want life insurance. You're not betting against yourself. It's a tax mitigation tool if you think of it differently. So whole life insurance gives you a fixed rate of return every year, 5%. I would argue it's better than buying a CD. And the reason for that is you're going to get a higher rate of return. Instead of 4, you're going to get 5. And instead of that 4 being taxable at the bank, this 5 is not taxable. So I think whole life. And the extra big benefit is, God forbid, something crazy happened to you. We're not wishing that, of course, but God forbid something happened and you died unexpectedly. Your family does get what we call income replacement. To replace all the years of your income, you would receive that in a lump sum. And by the way, that lump sum payment is tax-free as well. And that is what I view a fixed income alternative product, a product that will give you the alternative choice from owning a bond or a CD. Now, along those lines, just like that, there are also products that have a tie to equity markets. So instead of being like the Japanese investor over 30 years has lived through up 20, down 12, up 4, down 18, up of choppiness, you go crazy with the stress. Instead of living that way, there are products that allow you to capture the upside every year on equity markets or funds. On the equity markets, that upside is normally capped. Most products cap between 9 and 12.5% on something like the S&P 500. So if you're willing to give up those big 20% years to have the upside of the S&P capped but have no downside. So in the years that the S&P is down, you're at zero. You don't have any loss at all. That's very compelling to me, to have that as a stock alternative. And by the way, again, it offers that income replacement that if you passed away and you missed out on 20 years of your projected career income, your family would get those 20 years of income. Why do people not know about this? Well, for the most part, these products are sold by people that may not be that appealing. The licensure that you need is not very advanced. So pretty much anyone who's a good salesman can go get this license. And if you meet them, you might feel a little dirty after meeting them. You may need a shower. because they don't really come off as very ethical people. Some of the people in that business. The other thing that to consider is some of these products, these people are employed by an insurance company. They don't always allow you to sell the right product. The insurance company sells products that have high commissions. And then they sell these products that may have lower commissions, or in some cases, very small commissions. And when you're an employee of an insurance company, and the term is an agent of an insurance company, when you are employed as an agent, your legal obligation is to your employer. So these are the people that work at Northwestern Mutual, Mass Mutual, New York Life. These are large, well-established, for the most part, good companies. But sometimes they work for a manager that makes them sell products that may not be as great as a product that has lower fees. So we believe that if you're going to own equities and you don't want to live through the volatility, because remember, let's take that theoretical dollar. You lose 20%, you're down to 80 cents on that dollar. To get back to your dollar, the market has to go back up 25%, right? 80 cents up to a dollar, that's a 25% move. Compounding works both ways. So you have to remember that. And people forget, and they are 75 years old owning equities and telling me that if the market was to lose 20%, they couldn't take their family out to a restaurant to have dinner. That's how economically stressed they would be. They might have to sell their home. They might have to reduce the type of car they drive because the money they live on when they retire is fixed. And they don't even know what tax rates are going to be because most of their products are all taxable. So we're a big believer in creating tax-free income plans to fund people's retirement. Everything we do, we look at the tax ramifications of. And those are the comments I'll make as well to you going forward in the rest of this conversation about what are these structures. But I hope that gives you an answer. These are principal protected structures offered by the insurance companies to give people certitude to know they cannot lose their money. And they still capture all the most of the upside. There are products that have no cap on the upside. There are funds that give you the performance with zero cap on the upside. And we're not agents of an insurance company. We're actually independent advisors. And we actually have 40 or 50 companies we look at, and we look for best of breed products and represent our clients and bring our clients to the insurance companies when they need these products. Now, we're also an asset management firm. We run partnerships doing investing. Those products are not principal protected. They might be lower volatility. We run, for example, something called asset-backed lending we could talk in granularity about, but that's an investment strategy that has lower risk than owning directional stocks. Remember, if the stock market goes down 30%, most advisors feel they did a great job if they were only down 28%. They benchmark themselves to an index. Whatever the index does, that's how they judge themselves. If the market's up 12% and they made you 14, they think they're a hero. Well, when you take off their fees and expenses, you probably would have done just as well by owning the index. But our argument is you're going to do much better by not even owning the index, owning principal protected structures, which give you the performance of market assets.
Absolutely, that's quite interesting and almost sounds too good to be true. Honestly, right?
I hear that. I've heard that for 30 years now. Too
Yeah,
good to be true. I always say that. I would be in jail if what I was doing was not completely compliant and
right.
truthful. Because you can't do something. Even the great fraudsters eventually get caught. So what's
Yeah.
great here about what I do is these are you don't need to trust me. You're going to get a legal contract from a large insurance company, the biggest, John Hancock, National Life, Nationwide, biggest companies, double A credits. They're your counterparty, not Jason Mandel.
Yeah, absolutely. So to dive deeper into that, so let's say like someone is going to purchase life insurance. So before that, are these tools accessible even to the general public, and everyone can buy these? Tax
Yes,
saving and access to equities, only the upside. Are these accessible to
absolutely.
everyone? Yeah. Okay.
No, this is accessible to anyone of any net worth. One of the
Hmm.
things that's always bothered me by being a family office manager, and I've worked for billionaires, my clients are for the most part very wealthy. I have, average wealth clients as well, but for the most part, they're ultra wealthy. And it's always bothered me that people do not get access to certain products that exist in the market that are limited to accredited investors with $5 million net worth. One of the reasons I wrote my best selling book called Demand Transparency was I wanted everyone to get access to this information. And if they go to Amazon or Audible, they'll see the book. And I don't even sell it to me. All the money goes to charity. And I have a digital version for 99 cents. So I'm not looking to make $1 on this book. I'm looking to share information. I want to equalize the marketplace. And that's been my goal and my dream over my past 30 years of my career on Wall Street.
Right, absolutely. So everyone should go check out his book, and I'll make sure to put the link in the show notes. And besides that, so to go deeper into that, let's say someone is interested to purchase these life insurance, which are also tax saving. You get access to the upside, can invest in the equity markets via that. What exactly should they look for when they're going and purchasing life insurance, or what exactly should they ask for to get this exact product that you're talking about?
Sure. Well, I own a variety of insurance agencies where I like to employ people of high ethics, people that are not focused on making the highest commission, but rather the long-term relationship with a family. So, for example, if someone buys a product, we also offer asset management solutions. Why would you want to, sell them an inferior product with a higher commission if down the road there's an opportunity to work with them as their money manager? Or we also own in accounting practices. Why would you want to cut off a relationship when you have a chance to help somebody with their taxes and do that every single year? And there are very few good accounting firms. Most accounting firms, to be clear, are record keepers. You tell them what you did and they tell you what you owe. There's zero innovation in the accounting world. And most accountants today in America are frankly offshoring everything to India, where the tax returns are actually being done. That's the truth. So you have salespeople, again, smiling, shaking your hand, and making you feel good, but they're not even doing the work. And all they're doing is just sending what you tell them you did. So what we do is our whole core belief here is to be proactive, is to be able to show strategies that will be tax efficient. So the first strategy that I want to explain is something we call a tax advantaged corporation. And we actually have been doing this for over 20 years. People like Mark Zuckerberg have done this. People like the NVIDIA CEO have done this. He saved $8 billion in taxes. Steve Jobs' wife did this. A lot of NFL football players do this. There's a variety of people that have known that there are ways of using the tax law, again, not an interpretation. In America, we have people who run around getting tax structures. I call them shelters. These are not things you find in the law. Rather, these are interpretations of law. And the problem you find is interpretations of law change between a lawyer who develops a product, or does the legal work on a product, an entrepreneur that might develop some idea they have, your accountant, and then the more important person is the IRS agent, the tax authority that you live in. If they don't agree with your shelter, they will destroy it and they will make your life very difficult. And in certain cases, it could be punished. That's one of the reasons most good shelters come with a legal opinion. It's what we call a get out of jail card to tell the IRS, oh, who am I? I'm not a lawyer. I'm not an accountant. I hired these people. This is what they told me. Go after them. And that works. You tend to avoid jail, but you have penalties. So, what we're looking at as a firm are things that are in the tax code. I don't want to have a problem. I'm not afraid of an IRS agent calling me about one of my clients. The reason I'm not afraid is we do things that are in the tax code. We point to the code and say, why do you have a problem with your own code? If you have a problem with the law, call the senators and congressmen and change the law, or call the insurance department of a state if you don't like the fact that insurance is tax free. I can't do anything about that. That's the law. Change the law. And I find that to be very an interesting approach that we have, is being able to really go to things that are limited to the law. So, for example, the IRS says that you can donate 50% of your taxable income every year to charity. Now, of course, most Americans do not do that. That's incredibly generous. And more than that, it's hard to live on half your salary for most Americans. Obviously, it's hard to live on your salary for most Americans. So the reality you have is this rule the IRS has is really for the ultra wealthy, right? You take somebody who's super rich, they retire, they're not making any money, and now the IRS doesn't want them to be able to deduct every dollar in charitable gifts that they give against whatever income they may make from their passive investments. That's the reason, in my view, this exists. So you have an environment right now where these tax laws are in our favor. If you follow the law says you can give half your money away to charity. So we have structures that take advantage of that law compliantly. So for example, if you had an LLC, a business, and you were the managing member of that LLC, the managing member makes all the decisions normally. And if you had a share class for the managing member that had all the voting shares, even if the managing member only had 2% equity, understand the other 90%, 98% shareholder who might own a bulk of the equity may not have voting rights, may not have control over that business when you appoint someone. So in a scenario where somebody donates shares of a company, but still maintains the managing member status, they have an obligation to the shareholders based on an operating agreement. If they follow that operating agreement of the LLC, they might be compliant. But let's imagine that company has $100,000 in cash in the bank. If they have that money in the bank and you donate 98% of the value of the shares in that company, one might agree that you've donated $98,000 in effect. Now, the IRS makes you take certain discounts because it's a limited company, it's not an active market for that 98,000. So they might stress it down and let you get an $80,000 deduction, but you're getting a deduction on a bulk of the money that you've given away to charity. That money is no longer yours. So in this tax advantage corporation, if in the next year that company makes $100,000 and it flows through the company's shareholders, the money that was made, only 2% of that was made by the managing member, who's probably a taxable entity or an individual. The 98% was made by a charity. They might be a non-taxable entity. So that 98,000 may not be subject to taxes. That's an exciting view of growing wealth. Now you're growing it for the charity, to be clear. It's not yours. And there are ways the IRS allows a company to access some of the money on behalf of the shareholder or in relation to shareholders. So for example, if the IRS said you're allowed to substitute out that 98,000 that you're managing as managing member for the nonprofit, and you have the right to sub it out, but you have to sub in something of equal or greater value, the IRS is copacetic with that because you've not changed. It's like going from a stock portfolio and deciding you want to change it to a bond portfolio. You have the right to change assets. And that's what many of our clients do. They either keep the money in the tax advantaged LLC because they want to grow compound tax free, and they're very charitably inclined. They want the charity benefit, or they swap it out for an asset of equal or greater value. The asset the IRS always recognizes, which is liquid, which is principal protected, goes back to our earlier conversation. That asset is likely life insurance, whether it be whole life, universal life. The IRS is very comfortable and should be with insurance as the asset class. So this is describing one of many strategies we use to mitigate taxes, because if you made that 100 inside this LLC, you might, living in New York or California, you might have to give half of that away. Now you're giving none of it away on behalf of the charity that owns 98%. And on your 2% taxable income, yes, you're subject to taxes. But that's another example of that. Now, there are other more traditional strategies that we use. We call that a TAC, a tax advantage corporation, TAC. We have a TAT, a tax advantage trust. So most trusts, as I mentioned, pay taxes every year and on the growth. Now, there is a type of trust that does not pay taxes called a spendthrift trust. We don't have time on this call to get through that. We could bring a lawyer in that'll go through all the details. But this type of trust is which you name a charity or a beneficiary at the outset of the trust. They may have 70% of the beneficiary status of the trust, and that growth of their shares and of their amount of that they are a benefit of that trust would grow tax free. And that's very compelling because you can use that similarly the way you use the tax advantage corporation. So let me stop there. Any other question? And before we stop, I do want to talk more about PPLI because I think that's a great asset. But did I don't want to keep going. Is there other things you wanted me to address?
Absolutely. We'll talk about PPLI in just a bit. So, a lot of people put their money into 401k for tax saving purposes. So, how would you compare that to uh, investing in a life insurance versus 401k?
I hate 401ks. I think
Okay.
401ks are a fraud perpetrated on the American people. I am disgusted that the institutions have so desperately wanted to make money, they put people's retirement ahead of anything. A 401k is flawed because a 401k has uncertain taxation in these 401ks when people pull it out. They have no idea what the tax implications are going to be. Therefore, they have an uncertain retirement. Worse off, if you look at the product offerings, they need, because the 401k market is so large, they have to find products that are scalable. So the type of work that we do with arbitrage strategies, with asset-backed lending strategies, are inaccessible to the 401k marketplace. My wife's a lawyer. She has a 401k. The choices, I've looked at them, they're pathetic. They're badly performing mutual funds at best. These are products that somehow pay the 401k administrator extra fees, in my opinion. There's got to be some type of secret arrangement. Or maybe it's fully disclosed and we just don't read that thick document. I'm sure it's disclosed. But these are terrible products. What I believe people should do is take advantage of this tax advantage corporation that I mentioned to you. Let them break apart their 401k, destroy it, shut it down. The first step is to self-administer. There are companies that allow you to do that, where you can administer possibly your own 401k if you leave the firm. That's your first step. Have it transfer over there. And then from there, we believe in selling off the assets inside, in our opinion, because of the inferior quality of those assets. Now, the obvious statement everyone's going to make is, you've created a massive tax bill, Jason. It's terrible what you've done. You're evil. No. What we've done is we have an assortment of strategies which can eliminate the tax bill that comes from shutting down your 401k. So I mentioned the IRS allows you to deduct 50% of your taxable income to pay to give a donation. And that's what we talked about with the tax advantage corporation. Well, what about the other 50%? Well, the first thing is when we talk about life insurance, I don't believe anyone should pay for it. What does that mean? That's a crazy statement, right? Don't pay for it. What I mean by that is just like you go to a bank to finance a piece of real estate, you put down 20%, you buy a home and finance 80. My belief is you should finance your retirement tax-free plan. You should not pay for it out of your pocket. How do you do that? Banks in America are excited to finance insurance. Why? It's principal protected. Real estate's not principal protected. But if you want to take another form of property, 1911's Grisby versus Russell, the Supreme Court, Oliver Wendell Holmes, the famous Supreme Court jurist, ruled that life insurance is property. You take that to the bank and you say, I want to finance this kind of property. And they say, where's the collateral, Jason? And I say, don't worry about me. You can get all my financials, but it's not even of concern to you because your counterparty is the insurance companies. They've been around for hundreds of years. AA credits, billions of dollars. That's your counterparty, Mr. Banker. So now the banker will give you the money to finance the tax-free income plan, which is life insurance, that universal or whole life. And guess what? When they finance that plan, they don't need to ask you for much of any collateral because when you disintermediate the insurance broker who's not adding enough value, and you instead reduce the fees that are being paid on these products and spread out the fees over a period of time, now all of a sudden the surrender value in the insurance is very high. And when it's very high, the bank will use that as the main form of collateral. And if they take a little bit of collateral for the first year or two, that's fine. Then they release it as the value of the insurance contract goes up. Because again, if the market's up, Your cash value goes up, market's down, you're at zero. You haven't made any money, you haven't lost any money. So it makes a lot of sense to me. And then the last part of this is, of course, when you have the money that you've saved on taxes from this strategy, where do you put it? If you swap out the monies in the tax advantage corporation and you swap in life insurance because you want to give the charity the money you've given them and taken the deduction, where they have to know they have the certitude that at worst, at your death, they're going to get the insurance. You've got to prove that to the IRS. You get in a lot of trouble for stealing from a charity. You go to jail. So how do you prove that? You swap in life insurance. So now, when you've swapped out the cash, where does it go? And that gets to our most important structure, which is PPLI. That stands for private placement life insurance. And what we talk about doing is you take that money and you want to shield it for forever from taxation. And the asset that is forever shielded, it's not a regular trust, rather a life insurance policy where you can actually hire a third-party manager to manage your wealth. So you can pick your same person you like who manages your money, but instead of the entity being Jason Mandel Individual, Jason Mandel LLC, Jason Mandel Trust, now it's policy number 1248, issued by Prudential Insurance Company on the life of Jason Mandel. And all your stocks and all your bonds can grow tax-free inside of life insurance. And life insurance is protected from creditors. Even, God forbid, you got divorced, it's separate. It's not treated as community property. And you can borrow from it tax-free. You have all these amazing attributes that you benefit from by wrapping your wealth inside of insurance and then repurposing that life insurance we spoke about being financed. Use that as the death benefit that's required for PPLI. We call that synthetic reinsurance. Regular reinsurance is very expensive. It's like buying term insurance every year. It goes up, 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 up. You don't want that. You want to have a product that actually creates tax-free income for you. And it enhances the returns on your investment portfolio. This is financial engineering. This is a form of arbitrage, in my view.
Absolutely. Yeah, that's mind blowing on multiple levels. And I think a lot of people are not aware of this. So I'm glad we are having this conversation. Uh, and you mentioned briefly about how this also can be used as a safeguard for your wealth in case of a divorce, because a lot of time what happens is to have a divorce, a lot of your wealth goes away, and suddenly you're left with a lot less money than you had in the first place. So can you talk a little more about that how can these structures be utilized to protect your assets against events like divorces as well?
Sure. Well, this type of, again, the courts are very clear, and obviously in the states, each state is a little different when it comes to divorce law. But for the most part, the courts will look at certain assets that could be divided, and they'll very easily divide them up in the event of a divorce. Cash, a brokerage account, even a home could be sold, and the proceeds, can be divided. When the courts look at life insurance, it is treated differently. They do look at this as a special structure which is there to protect the family. They do look at this as something that's a way of providing generational wealth in certain cases, a way of handling that estate tax. Think of the farmer. The farmer has 100 acres. When they die, the farmer theoretically owes 50 acres to the government, or the value of those 50 acres. That would reduce the farm in half. If there was a life insurance policy that existed in which the farmer paid it up over 10 or 20 years, now upon the mortality, the money that comes from the insurance may not go to the children, but it goes to the tax authority to pay the tax on the farm. And that allows the children to stay on the farm, not sell half the farm, and keep it. My favorite story is one of my clients had 3 Picasso paintings. He also had 3 children. His dream was to give each child a Picasso painting. Well, guess what? The IRS didn't like that dream. The IRS said, give us 1.5 of these Picassos. So what does that mean? Give me 2 of the Picassos, sell it off. And he didn't want to do that. So he was able to use life insurance, finance life insurance, because he didn't have the money to necessarily pay for it. He didn't want to pay out of pocket. He went to a bank. The bank paid the premiums for him. Upon death, the bank was returned the money that they lent plus interest, and he used the remaining amount to pay the IRS the estate tax on his art collection. Brilliant. And now his dream of each child getting one painting was realized. So on divorces or on death, this is where the IRS has very strong views. And for us, we use insurance as an asset that the IRS will normally never touch. Now, one way we can have a certitude of that is we have an independent trustee. So instead of the person getting divorced as trustee, you hire a bank or a trusted advisor or friend as the trustee. And if the court even asks about the assets in the insurance policy, the trustee says that the beneficiaries of this trust are the children. I represent the children. I could care less whether the parents are getting divorced. And the IRS respects that. And not just the IRS, the divorce courts respect that. And they understand and say, you know what? This is not owned by Mr. Smith and Mrs. Smith. This is not an asset that we can even try to go after. They no longer own it. An independent entity, an irrevocable life insurance trust is normally the owner. And therefore, with an independent trustee, which is what we advise, there is no issue in the event of a divorce having to divide those assets. And imagine there was $10 million sitting inside the insurance policy. That money is for the benefit of the children or any of the other beneficiaries, not the spouses getting divorced.
Right. Absolutely. Yeah, that's quite interesting and can be quite helpful for a lot of folks trying to protect their assets in case of bad marriages, if they're in one or get stuck in one. But now moving on, how can family offices operate more like banks?
Well, one of the greatest strategies that we believe to invest in, we're not, as we said, we're not believers in long only equities. We're not believers in long only bonds. We are, if we're going to have exposure to that, we do that through the insurance products. Or we allocate out to other people who are more talented than I am at picking stocks. The research is pretty clear. It's very hard to beat the market for any extended period, so I don't even try. But the concepts of what we want to do in talking to people and giving them a real solution is asset-backed lending. Asset-backed lending is the idea of, in effect, being a bank. So let's talk about what's an asset that banks lend on. The asset is real estate. So you take a property, you make the person put down 20% for a residential property. It's their home. They don't want to be kicked on the street. So the chance that they want to let that home go is very low. They're going to find a way to pay that mortgage payment so they're not kicked to the curb. The other investors for real estate are commercial investors, and that's different. They're going to ask for these days 40%. Why? Because commercially, not living in it. If it doesn't work out, you're not going to be on the street. You're just going to lose money. So that's why banks want 40% collateralization effect to ask you to put down that money. So how does a family office do asset-backed lending? Well, the banks do these lendings pretty well. So what I believe is family offices need to look at other assets that people want to finance. So at my organization, we will finance esoteric assets. The one asset that I know very well is insurance. So let's recognize the fact there's a secondary market for unwanted insurance. That secondary market is called the life settlement market. If you Google it, you'll see everybody from Warren Buffett to major institutions owning unwanted life insurance. They buy it, they hold it, and when someone passes, they're the beneficiary. Even big corporations do it. Walmart owns hundreds of thousands of life insurance policies on their former employees who have retired. And when they die, the families don't get it. Walmart gets the money. Same thing with Chase Bank, JP Morgan Chase. Jamie Dimon owns policies on the tellers. Why does he do that? Well, it's a nice perk while you're working there to have some life insurance in the event you die, but chances are you're not going to die. And instead, when you leave, you lose the insurance and he keeps it. And that becomes an asset. So what we've done is we've lent against insurance assets. Instead of people selling their insurance when they no longer want it or can afford it, we've loaned them money against it. We like to look at esoteric assets like insurance that banks don't lend on. We also will lend on unique assets that people don't even recognize as an asset. For example, cash flows. We do factoring. We look at all unique different strategies. And when it comes to real estate, If we like an opportunity, want to charge a higher rate of return, we're not going to lend the bulk of the money. A real estate developer may go out and borrow commercial debt at low interest rates from banks, but they may be short money to do the next deal to put down that 40%. That's where we can play. We can participate in lending money to a developer or even being a developer ourselves in conjunction with an operating partner. And then we're putting in the money that they need as a loan in order to benefit. But we're looking at unique assets. We have a client now that owns $27 million in account receivables from New York State and from large insurance companies. It's a medical group. This person is illiquid. They are really being hindered by the state of New York not paying them on time. It's cruel what they're doing. They're making their business suffer. How are they expected to pay their employees if they're not getting paid? So they've come to us for a solution because, for the most part, banks may not understand, or this person happened to have had a regulatory issue 20 years ago that they've made amends for. Some banks won't work with them. So we're looking at that transaction today once I get off this call, and we're going to examine these account receivables and determine whether or not it makes sense. They're only looking to borrow $5 million against $27 million in income over the next year. That's a pretty good risk. And I'm not trying to be a braggart, but I am able to charge a much higher rate because there's not a lot of people that make these types of loans. These are asset-backed loans. And because they need the liquidity now, the borrower is willing to pay higher than what they would borrow at a commercial bank because the bank won't touch this deal. That's a good example. So I believe family offices should look at strategies like asset-backed lending. We currently partner with 7 other family offices, providing them asset-backed lending opportunities.
Absolutely. Yeah, that's quite interesting. And it's been a really insightful conversation, Jason. And I wish I could just go on. And you would just keep giving us the things that we just don't know about or just blindsided by, because maybe the industry doesn't want us to know that or for other reasons. But I'm glad the points that you shared in this conversation. And hopefully we'll get a chance to do a sequel of this episode after some time, so we can share some more strategies as well. But for today, thank you for your time, Jason, and do let our audience know where they can learn more about your multifamily office, where you can help them employ some of these strategies, as well as where they can find you, and about your book as well. So yeah.
Excellent. Excellent. Yes, they're welcome to come to our website. It's www.themandel.family.office, THEMANDEL, familyoffice.com. And there's a lot of contact information there. The book, again, was Demand Transparency. It's on Amazon, Audible. They're welcome to reach out to me that way as well. And my email is Jason, JASON, at themandelfamilyoffice.com.
Awesome. I'll make sure to put all those links in the show notes below for easy access. Thanks so much for making time for this, Jason. And it was an incredible conversation. I got to learn a lot. I'm sure so will our listeners. Thank you so much. And I wish you all the best. Thank you.
Thank you. Take care. Bye.
Same to you. Bye.